Hello everyone, welcome to this channel. So Federal Reserve raised the interest rates by 25 basis points and raised it up to 5.25% to 5.5% range in today's FOMC meeting. This will be the 11th rate hikes since Federal Reserve embarked on control inflation since March of 2022, and this will be the highest short-term interest rates in this country for last 22 years. So with this interest rates rising, all the banks overnight borrowing rates are going to be going up, as a result of which all the consumer lending activities, they're going to be more expensive. Any kind of mortgages, credit cards, buying cars, all these rates are going to be going up. Good thing is, if you are investing money as a depositor, you're going to be getting better rates as a result of the raise of interest rates. So if you have some CD, maybe you could be earning around 5% interest rates, or your savings account could be around 4.75% rates, which is to be 0% year and a half ago. So this is good if you're a borrower, but if you're not good if you're a consumer. Now looking forward.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
The Federal Reserve, they're not committing what's going to be happening in terms of the rates outlook. Are they going to be raising any interest rates in the next meeting, or before the end of the year, or next year? The chairman, Jerome Powell, he said it's going to be all data dependent. Next meeting is scheduled on September of this year. But in between now and the next meeting, the Fed is going to be getting a lot of additional data points. I think they're going to be getting 2 CPI prints for the month of August and September, and they will also get unemployment numbers and GDP deflators. So the Fed chair, he said that it's all going to be data dependent. If the inflation is basically mute, he may not raise interest rates. But if they suddenly if the CPI number picks up, or the labor market basically gets more tightened, he might. So it's it's unknowable at this point. He also commented basically on various things around basically the labor market. The labor market is still very tight. So in terms of number of jobs available, although it is getting lower and lower, still there is more demand for basically the jobs. Between the seekers and the people who are looking for jobs, there are more people they are looking for employers than people looking for jobs. So that could basically raise the wage pressure. But Fed, whatever he said, that the wage pressure, they are having good symptoms.
Another step by raising our policy interest rate a 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers.
Forward that only certain people middle people who are making less money, their wages are going up, not people people who are very rich. So that's kind of like the outlook. In terms of basically other outlooks, he's saying that he's going to be keep the interest rate higher because they have the target to bring down the CPI, the inflation, at 2%. Currently, the inflation in the last month of July, it has been the core CPI is at 3%. So still there is a 1% rates. They would like the rates to come down, or basically like the inflation without energy and the shelter, that's still high, and the energy prices are actually creeping up a little bit in last couple of months. So it is quite possible that there could be additional inflation pressure showing up in next CPI prints. So Fed is going to be watching how the inflation outlook looks like. So it is very unlikely that he will cut the rates down. So for Fed to basically decide to cut the rates, that he really wants to be sure that the inflation numbers are going to be coming down. But at this time, the inflation is still very high, and Federal Reserve, they want to have an option in case inflation picks up, that they can raise more interest. It's quite possible they might raise interest rate higher. The stock market had a very mute response after the rate hike was announced. The Dow Jones Industrial Average raised by 82 points. I think S&P almost fell down 1 point, and Nasdaq fell down by 17 points. So it's not a big amount of market movement in any of those indices after this Fed announced their interest rates. So going forward, I think people are saying there may be rest of the year the rate will continue at the minimum, whatever rate it is, short-term rates, or it could go up, or if the inflation suddenly comes down, potentially Fed will look into cutting interest rate, but that's not going to happen by the end of the year. So in the meantime, the yield curve is inverted. 10-year rates are a lot shorter than basically 2-year rates. So there is some indication of some sort of inflation. Although they're saying the current GDP has been the U.S. economy is growing at about 2%. With this high interest rate, perhaps it could come down a little bit, 1.5% to 1.75%, but it's not going to be negative. So if that is the environment, if that works, and if there is no GDP contraction, so there will not be any recession, and stock market could actually bounce higher, because after today's market, the market was very mute. And looking forward, last couple of weeks, market has been roaring, going very high, and between now and the end of the year, it could still go higher, especially cyclical, or people with all the stocks with good income, solid companies. Facebook, I think they announced Facebook is gone up quite a bit at the end of the day today. I think the market could be better. Hope you like this video. please subscribe to my channel and hit the like button so that you could watch more of these videos. Thank you very much. Appreciate. Have a good day and speak to you again.